What that shows me is that the Fed has enough new tools to basically prevent anything the markets from breaking. So let's say, for example, we do have an episode like the UK, like what we see in the UK, where we have instability in the Treasury market. Well, the Fed would come in and they could uh, do some kind of emergency liquidity facility. Or let's say we have instability in the corporate bond market, something breaks, well, the Fed can come in and act as lender of last resort. So what I'm getting at is that these new tools that the Fed has pioneered vastly expand its influence and its ability to keep the system together until it brings out inflation.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. As many recent experts on this channel have lamented, it's hard to be an investor in today's market when the price action of securities is driven far more by Fed policy decisions than by underlying company fundamentals. As a result, the global investor community is reduced to speculating on what Jerome Powell and the 11 other voting members of the FOMC, the Federal Open Market Committee, decide to do next. To better understand the inner world of the Fed, I've recently interviewed former Fed senior economist Lacy Hunt, former Fed advisor Danielle DiMartino Booth, and Fed policy journalist Pedro de Costa. Today we add to that list by sitting down with Joseph Wang, a former senior trader on the Fed's open markets desk. He understands the plumbing of how things work there intimately. Joseph, thanks so much for joining us today.
Thanks so much for inviting me, Adam. I've been a fan of your show and I'm delighted to be here.
Thanks. Well, it's great to have you here. And as I just said, really the Fed is foremost on pretty much everybody's minds right now. I've got a lot of Fed-related questions here for you, but before we jump into them, let's just start at a high level. What is your current assessment of the global economy and financial markets?
Well, first of all, Adam, I think you're spot on in that the Fed is the biggest driver of markets. Now, earlier in the year, the Fed was very clear of what it was going to do, both by tightening financial policy, by raising the short end, and also quantitative tightening. And we've seen that play out with the rates going higher across the curve and equity markets mechanically declining as well. Now, at the moment here, we see that yields are about 4%. Markets are pricing in pretty hawkish Fed for the coming months, and equity markets have declined a lot. Now, I'm actually pretty constructive on equity markets right now, and I'll tell you why. Now, I believe that the global economy is not going to do very well in the coming months and years because the Fed is ultimately the world's central bank, and when it raises interest rates, it has an impact on the global economy. Many companies abroad and here borrow in dollars, and so that affects it. However, there's another aspect to this as well, and that is that when the world is not doing well, when you have a geopolitical risk in a weak global economy, a lot of investors hide in the US. Now, I'll give you an example. Now, if you're a Japanese investor investing in the S&P, you would have seen the S&P index decline throughout the year. However, your currency would have also depreciated significantly throughout the year. So at the end of the day, in yen terms, you're actually not that bad off. And so that's the same for an investor from Europe or an investor from the UK. So I expect that going forward, since the Fed is expected to keep policy tight in the coming months, there's going to be a lot of foreign capital from all over the world coming in and buying US assets. So it's going to be supportive of US assets going forward. And eventually, of course, the Fed will likely pivot. And by pivot, I mean perhaps slightly reduce its restrictive stance. And then when that happens, I think asset prices will take off. So at the moment, I'm not bearish. I'm fairly constructive going forward.
Okay, and great kickoff here. If I can sort of recap a little bit, it sounds like you're saying global economy, U.S. economy maybe even not to do so great going forward because the Fed is raising the cost of capital. It's trying to bring down demand that's going to slow economic growth. But you just said you're somewhat sanguine on the markets, mostly for the reasons that Brent Johnson espouses in his dollar milkshake theory, which is
Yes.
that these same issues are hitting the rest of the world, in many cases even harder than they are in the US. And so capital is going to flee to where it is best treated or maybe say least abused and that's highly likely to be the U.S. market, and that's going to prop up the price of securities here as capital flows into those markets.
I think Brent Johnson is spot on in his description of the milkshake theory, and I think we're going to see it playing out, especially when we see that other markets like the UK have been more fragile, and so there seems to be a limit as to how high yields can go in other markets, whereas there's less of a limit so far, at least in the US, and so interest rate differentials should continue to widen going forward. But as you suggested, Adam, markets are not the economy. And so even though, let's say, perhaps earnings or in the real economy does not do as well, ultimately financial flows are a bit separate than the real economy. There's a connection between the real economy and the financial economy, but just a connection. They're not the same thing.
Okay, great. All right. Well, look, so we brought you here today to talk about the Fed. So I'm going to ask a variation of the question I just asked you about the economy and the markets. What is your assessment of current Fed policy? Is it appropriate for the situation we're currently in, or do you think they should be doing something different?
I think they're doing the right thing right now, and I'll tell you why. So at a high level, right now, what we have inflation that's very high, 8%, and we have an employment rate that is very low. So the Fed is a two mandate bank. It wants to have stable inflation and full employment. Its employment mandate is being met, but it's way off on its inflation mandate. So temporarily, it's a one mandate bank, and all it cares about is inflation. Now, I think of inflation as persisting if people are able to afford higher prices. Once people are no longer able to afford higher prices, then naturally prices come down and we have inflation going lower. Now, how do people afford higher inflation? Well, I think of it as three ways of doing that. The first is wages. If you have, let's say, wage increases of 5% a year, obviously you can afford 5% inflation. That's one way. Another way is borrowing. So let's say interest rates are, pretty low, then you can continue to borrow to afford higher prices. And the third way is through asset inflation. So let's say that prices are going higher, but my S&P stock index has also gone up a lot. That means that I can continue to use my stock portfolio and other assets to fund and finance higher prices. So at the moment, what we see through these three channels is that wages continue to be very high. I think the wage tracker has gone down a little bit for the first time in several months, but still remains at about 6.5%. So if you have 6.5% wage growth, obviously people can continue to afford much higher price changes, much higher inflation. So you hear this from the Fed a lot as well. We need to have unemployment go higher, which is another way to say we need to have wage growth slow down. Otherwise, people can continue to afford higher prices and you can't get inflation under control. Now, the second part, which is borrowing to afford stuff, well, that's actually been working through the system. We see mortgage rates at 7%, and correspondingly, house prices have continued to decline. So that channel is working so far. However, I would also note that if you listen to recent bank earnings, they'll tell you that credit growth continues to be very strong. So it seems to be working, but working slowly. Now, the last point where people continue to have money to spend is the asset market. Now, the S&P 500 has gone down a lot this year. There's no question about that. But it is also comfortably above pre-pandemic levels. And if you own a home, your home equity is also comfortably above pre-pandemic levels. So it seems so far that what the Fed is doing is working, but it's still inflation still looks like it's going to remain stubborn for the foreseeable future. So monetary policy acts with a lag. So I think they're doing the right thing so far. What would be wrong, though, of course, is I think the cut rates too early. If you listen to Chair Powell, he'll talk a lot about what happened during the 1970s. And during the 1970s, the perceived error was what they say the stop and go policy, where what would happen is the Fed would raise rates, inflation would come down a little bit, then they'd cut rates, and inflation would come roaring back. So they really want to ignore, don't want to, I'd say, make the same mistake as the 1970s. So what they're doing right now, raising rates to, I'd say, 4.5%, 5%, and then holding it, I think is the right policy, and we're seeing it work right now.
Okay, great. You are touching on several questions that I have further down my list that I'm going to pull up here now. One is I totally get the risk that you're talking about, and I've parroted it a lot of late, which is, hey, if the Fed gets forced, if they pivot too early, either by choice or because they're forced to by some sort of financial instability event, then they risk getting trapped into a 70s style stop and go situation like you described. But increasingly, the question has come up, and I was actually going to record a discussion on this today with Stephanie Pomboy, and unfortunately she's dealing with a head cold and we had to push it off. Hopefully it happens soon. But the question is, there's so many deflationary forces that are out there right now. And to a certain extent, even, there's the old saw that high prices are the cure for high prices, right? And the Fed is already, it's hiked a lot. And there's a delay from when the hike gets made to when you see the impact of the policy out there. So the question is, even if the Fed were to pivot and change policy, would the CPI really head back up? We just are coming off a decade where the Fed was doing kind of, endless different rounds of QE, and at least as measured by CPI, didn't really impact the CPI very much. The Fed was talking through most of that decade about inflation being too low and, trying to stimulate it to get it to run a little hot and all that type of stuff. So assuming no pivot that also requires fiscal stimulus, which I think a lot of people look at as really the true trigger that ignited, the runaway CPI here, would a Fed pivot automatically mean CPI goes back up and we're stuck in stop and go, or maybe it wouldn't? What do you think?
So I think you raised a really good point. Just how much influence does the Fed have on inflation? Fed did low interest rates and quantitative easing for almost a decade, and it seems like CPI inflation didn't go up a lot. So I think at a high level, inflation is the Fed's responsibility, but unfortunately, it's not all up to the Fed. Inflation can be caused, for example, by fiscal stimulus, as you noted. And this is actually true in general. The Fed sets interest rates, which impacts fiscal policy by changing how high the deficit is. When the Treasury has to pay high interest rates, there's more deficit. And the Treasury also impacts monetary policy by depending on where it issues its debt. If it issues more longer-term debt, it puts upward pressure on longer-term interest rates. And of course, if the Treasury is spending a lot of money by printing treasuries, so to speak, that's also inflationary. So, but to your question specifically, what would happen if the Fed started to lower rates? I do think CPI would go higher a bit. And I'll tell you, going back to the framework that I discussed earlier, if the Fed were to lower rates, I think two things would immediately happen. First of all, the equity market would go to the moon. And I think there are many people positioned for that right now. And so if you have an equity market that's at S&P 5,000, people have a lot more money. Maybe crypto comes roaring back to life. If that happens, then obviously people have much more money to spend, and they've shown an willingness to spend that money. The second thing that would happen is that it'd be a lot easier to borrow money too. So you could have house prices, again, go back up, which eventually feeds into things like rental prices, which would feed into CPI as well. So I do think interest rates matter. And maybe the relationship is not as strong as it used to be, but if the Fed were to cut rates, I think inflation and CPI would come back up based on those three channels.
Okay, it's interesting because I do understand that logic, but again, I go back to the fact that we just had a decade where year after year, financial asset prices went higher and higher, and housing prices went higher and higher, and crypto prices. I mean, everything was up to a crescendo prior to the coronavirus pandemic, and of course, we sent them to the moon with the 10 trillion combined monetary and fiscal stimulus, but through all of that until just the past year and a half, CPI really didn't go anywhere. So my brain wants to agree with you. I just look at that data and say,
And no, that's a very good point that you make. So I actually think that, so you mentioned earlier, there are structurally deflationary forces in the world. I actually take the opposite view to that. I think there are structurally inflationary forces in the world, and it's those inflationary forces that are actually emerging right now in combination with loose monetary policy that has in part brought upon this inflation. And I'll describe two of the big secular inflationary forces that I see in the coming years. The first is that there's a structural decline in the workforce. Now, if you look at, and I'll send you this, you look at a chart of growth in population, working age population, so people between, let's say, 25 and 65, you'll see something very interesting in the US, and that for over 50, 100 years, that demographic has been increasing up to now. Now it's not increasing, it's plateauing. And if you back up globally, look at Europe or look at Canada or look at China, that key population, the working age population, is decreasing. So structurally speaking, the supply of labor in the world is declining. Now, this was always going to happen. We were always going to have a declining workforce. But if you look a little bit deeper into the data, what happened during COVID was that we basically pulled forward that decline. When we tried to, so there's a lot of talk about people not being able to find workers. When they go look at the data, what they find is that the workforce participation declined significantly in 2020. Obviously, everyone was staying home for COVID, and eventually it all bounced back up, except for one demographic, the 65 plus.
Right,
And
the Great
so
Resignation, a lot of early retirements.
yes, so basically, what was always going to happen, a structurally decline in our labor force, happened earlier. It was pulled forward. So these rising wages, the for hire signs that we see everywhere, well, that's something that I think will be with us for the coming years. And if you have a structurally declining labor market, that means the supply of labor decreases, price of labor goes higher, and so wages have to go higher,
Wait,
structurally speaking.
yep. Before you get on, I know you get another one, but just on this point, and I haven't looked at the data nearly as much as you do, so I'm actually very interested in your thoughts on this. So I understand that that places pressure on wages to go up, and people would say, okay, well, that's inflationary. At the same time, though, we theoretically sort of have a shrinking labor force, right? So what you're talking about. So that means fewer workers that are producing, and we have more retired people. And at some point, that baby boomer retiring at 10,000 a day turns into a baby boomer dying at 10,000 a day. So we have less consumers, right? Because people downshift their consumption in their retirement years, and then of course they really downshift their consumption when they die, right? So net, what is it inflationary or deflationary? I get that wages for the workers who are working go up, but productivity must take a hit and consumption must take a hit too.
So you're exactly right. And just to preface this idea that I'm discussing, I didn't come up with it. It's from a person called Charles Goodhart, who's an economist who used to be a policymaker at the Bank of England and a professor. So I just need to give him credit. He's done brilliant work on this and actually has an entire book written on this. So to your second point, and this is also part of Goodhart's argument, is that when you retire, when you age, you don't actually consume less. So you don't work anymore. So you don't produce, supply goes to zero. But demand actually doesn't go to zero, because when you retire, maybe you go on vacation, maybe you're still eating, you're still going to restaurants. And more importantly, you need more medical care. So the demand for services actually increases in some certain areas. So it's this huge macro mismatch between fewer people working, and yet the demand for goods and services doesn't decline a lot because people who retire continue to consume. And that's a huge imbalance there. That's going to be with us for many years. And eventually, yes, you're exactly right. Those people will pass away, and maybe that's kind of far into the future though. So until then, and I think we're decades away from that point though.
Okay, so you think net, can use a term I use a fair amount. There's sort of a pig through the python,
Yes.
where the boomers continue to still consume. I'm going to say they don't consume exactly as much as they did when they were working, but they don't drop to zero. They're maybe 80, 85% of what they were spending before.
The composition changes. The composition. So you're exactly right. So they're not going to go buy a big house. they're not going to go buy a Ferrari, but they're still consuming stuff, and they're consuming a lot more medical services. So
Right.
that's a change in the consumption basket.
Right. So,
But
and that actually does support GDP. It's not, yeah. So there'll be a shift in terms of how that consumption is being spent, and maybe you'll see sort of contraction in certain industries, right? But we'll,
right,
I don't know, we're really kind of
exactly,
speculating here at this point. But
exactly.
okay, but basically you think net it's still inflationary, and I trust your data a lot more than my intuition here.
So I'll attach some articles for your audience, but just do this thought experiment. Let's say right now, half the population retires and they all have enough money to fund their retirement lifestyle. What happens? Well, if you're retired and you have money to spend, you continue to spend, and who's going to do all the work? So that seems to me uh, that it will increase the demand for goods. And okay, so supply and demand imbalance will create higher prices just until all the retired people pass away, like a pig passing through a python, as you actually I like that example, as you say. So that's I think what's happening right now with the labor market, and which is why you see this actually globally in Europe, in Canada, basically everywhere. And if this persists, then that means prices can continue to persist because labor is actually, it's like the super core measure of inflation, as Larry Summers would say. It goes into everything. And if the price of labor is going higher, 5, 6% a year, then the price of everything will have to continue to rise as well.
Right. It's like energy, which I'm guessing might have been the second factor you were going to talk
Uh,
about.
Not and actually no, but that is also I should have mentioned that's super important as well. Many people have done great work in on energy. What I'm going to talk about the second point is how all this is financed. So again, inflation happens when, let's say, demand pushes against supply. We just talked about fewer workers, meaning there's less structural supply. You can think of it as less real GDP growth or maybe no GDP growth. Obviously, if we have a declining population, it doesn't make sense for real GDP to grow every year. Now, how is this demand financed? And it's financed through deficit spending, which, in my view, is another form of money printing. So if you're retired in the US, you get Social Security, right? Where does Social Security come from? Uh, the government just issues treasuries. Now, actually, before I go into this, I actually at a high level, I'll tell you why deficit spending is the same as money printing. And this is helpful to me because I think the Fed has been unfairly maligned by its quantitative easing, because the real money printing actually doesn't happen with the Fed. It happens with the US Treasury. For example, let's say you work at a company and every 2 weeks you receive your salary of $1,000. It gets wired to your bank account. Let's say instead of getting $1,000 wired in your bank account, you got $1,000 in treasuries in your Charles Schwab account. Is that really different? Now, I would say that it's not, because if you think about it, $100 bill and $100 in treasuries, not that different. $100 in treasuries is really just money that pays interest. They're both issued from the government, both no credit risk, and both highly liquid. So when you're looking at the federal government doing trillions in deficit spending, what they're really doing is that printing treasuries and using them to purchase goods and services. They are the real money printer, in my view. And we see that happen during COVID. So going back to our second point, all these Social Security, Medicare, all that stuff, that's financed by money printing, um, unless the US government raises taxes, which doesn't seem like it's willing to do. So we're going to have more and more fewer services and demand that's financed by enormous amounts of deficit spending. That has to be, I think, tremendously inflationary going forward. Now we have checks and balances to try to balance this out. We have the Fed, will try to fight against that, and perhaps we'll have higher taxes by Congress or something like that. But that's all in the future. Um, Secularly speaking, it seems to me it's inevitable that we have these very strong forces pushing for years of higher inflation.
All right.
Without even going to it's like energy and stuff like that you mentioned, which is also very important.
Yeah, and I agree that right now, at least right now for sure, energy is inflationary as an input. I'm also very much on board that we have a lot of structural underinvestment in that space that may prop up prices for a lot longer than we would like. But it doesn't mean that it couldn't come down in periods of recession, which is kind of where I want to go into a couple of different directions to what you talked about. So let me get them on the table. One is recession. One is just debt levels and interest on that debt. So let's talk with recession first. I know you think that a lot of capital could flow into the U.S. financial markets seeking safe haven, but as we talked about, that is different from the economy. If you look at what's happening right now, the pressures on corporate America are, I want to say deflationary, but I mean, they're inflationary pressures that are bringing down corporate profits, right? So we have a margin squeeze going on. We have the Fed raising rates to bring demand down, but that's also raising cost of capital. So it's kind of a perfect storm for a lot of these companies. The economic growth has been slowing. We did see a big jump in Q3. I'm not necessarily sure you can say it's due to like a healthy resumption in commerce. Sometimes has to do with the way in which they calculate GDP. And looking forward, it seems, I'll use the word inevitable at this point. You may have a different opinion, but that earnings forecasts for next year are going to have to come down just to match reality. And it's going to put, downward pressure on stocks, which is going to affect the capital structure of a lot of these companies. Long story short, there are a lot of people, including Bloomberg just came out this morning with a headline that said probability of recession is now 100%, is calculated by Bloomberg. That doesn't leave a lot of wiggle room there. So if we indeed are entering a recession, one that potentially could be accompanied with substantial layoffs, which I think the margin compression argument I just made says is for sure a possibility. In the near term, meaning the next year plus, could a lot of the sort of wage inflation pressure that you were talking about go away? Wages don't rise a lot when people are getting shed, by the millions in corporate America if it gets that bad.
Definitely, if there's less demand for labor, then you can have higher unemployment, and that's what happened, for the past few decades. It seems mechanical, right? Less business, less demand for labor, so there's more unemployment. But again, there's this huge structural force happening. There are fewer and fewer workers. So because of that, I think it's unlikely that we would just suddenly have a huge recession when a lot of people are going out of work. I'd also make a point about corporate America. So again, we are in an inflationary period, and by definition, that means prices are going higher. So corporate profits are nominal as well. So I think that when you have higher inflation, corporate profits are nominal. Maybe they could continue to grow, maybe not as much as in the past. Now, profit margins will probably come down because you have higher wages and higher costs across the supply chain. But if you look at a chart of profit margins, they're actually enormously high, enormously fat right now. So
Right.
if they were to go down, they would basically just going back to normal as well. Something that I think is really important that I think fundamentally changes how we should view the economy going forward, though, is the public policy response. So I think, at least I grew up and I studied in a worldview where we should have, free markets, where we should have less interference from the government into the, let's say the markets, the economy. But that's actually very clearly not how the world works anymore.
That's crazy talk, Joseph.
So if you recall, I mean, just a few weeks ago, we had President Biden forgiving a bunch of student loans, hundreds of billions of dollars. There's a huge willingness from the public policymakers, from let's say the fiscal authorities, to give money away. Now, if that culturally has become more acceptable, and I think it has, I actually never hear anyone talk about the deficit anymore. Every deficit hawk has basically been slain. So if that's the public policy reaction, then I think it's very difficult to say that we would ever be in a situation where we have like a huge depression because people would just give money away. We could definitely have lower real growth, and we have to have lower real growth if we have a shrinking population. But if the response is to just give away more benefits. It seems like it's won't be painful from a human perspective, and it's also not be as too bad for profit margins because the government continues to spend.
Yeah. So again, I sadly don't disagree with what you just said. I guess first off, in the near term, I think that's a accurate long-term statement, or at least midterm statement. In the near term, we're about to head into these November elections, and I know you're not a political analyst, so I know I'm asking you to talk about something that's outside your scope of expertise. But do you think that the appetite/ability for fiscal relief will be diminished if we have at least a divided Congress after the elections?
Yeah, that's a good point. So very likely we'll have a divided Congress based on what I read from political analysts. So yeah, with divided Congress suggests lower fiscal stimulus. However, I would also note though that I think traditionally we think of Republicans as being more, let's say, fiscally conservative, but they seem to all support the big stimulus plans
Yeah, they've certainly
in
been very
2020.
guilty of all that. Yeah.
So, and I'll actually point to something else too. So this administration has shown a willingness to kind of do whatever it takes to win. So I take as an example forgiving student loans, right? I'm not even sure the White House can unilaterally do that. They did it, and now of course they're releasing more money from the SBR. So more oil from the SBR. So they're showing a huge willingness to I guess use uh, their executive power to do stuff. There are other things that they can do to actually support the markets that don't involve Congress. And one of them is what's been floating recently in the news, and that is Treasury buybacks. So what that would mean is that basically the U.S. Treasury, one way to do it, and I don't know exactly how they would do it, would be basically to issue more short-term dated treasuries called treasury bills and buy up the less liquid stuff, let's say off the run coupons. Now, that would be supportive of markets by doing two things. It would help add liquidity back into the banking sector because it's a way for money to move from the Fed's reverse repo facility back into the banking sector.
Mm-hmm.
And it would help stabilize the bond market because you'd have this stable bid there from the Treasury this time instead of the Fed. So that I think would be one way that they could support markets unilaterally without any authorization from Congress. And I'm sure there are many other ways that they can think of as well. So even if we do have a divided Congress, I think politically there's just a lot of leeway to do things.
Okay. All right. So yeah, political Congress doesn't necessarily mean gridlock on some of these fiscal
on markets, at least on markets. And yes, who knows? Why can't they if you can forgive a few hundred billion, why not forgive all of it? Now, what would happen if they forgave all the student loans? I think that's a pretty meaningful fiscal boost to the economy, and that could, and it seems like they have the right to do that, even if they have gridlock. So it's a willingness issue rather than a. So I would just say that they have tools, even if they have a divided Congress.
It's a legal issue too. I know it's going to be challenged, and maybe even what's been announced may not be allowed. But who knows? And a lot of this is, you ask forgiveness, not permission, right? So you see what you can get away with, right?
Exactly.
There may also be a social revolution at some point. We've talked a little bit on this channel about the social ire that the forgiveness engenders in at least a percentage of the population because it's so preferential. Doesn't seem to be enough that people are marching, on Washington yet, but you never know. There might be a boiling over point at some point. But again, that's outside of both years of my pay grades here. All right, fascinating discussion. So many threads I want to pull here. Let's see here, but I want to try to get this back on track for the arc that I was sort of trying to drive us through here. Okay, well, let's get back to the inflation monster that the Fed is all armored up to slay here. What do you see as more likely? That the Fed is able to continue its campaign until inflation is down where it wants it to be, and I'll be generous and say somewhere between 2 to 3% CPI, or do you see some sort of financial instability event happening beforehand, the Fed technically breaking something and having to pivot sooner. And, we just got a little bit of a preview of what this might look like in the UK. So it's not completely academic here. So what do you think is more likely?
So I think the history is that the Fed continues to hike until something breaks, but I'm going to go on a limb and say this time will be different. And I say this because the Fed has a lot more tools this time around than they had in the past. Now, if you recall, back in 2020, the Fed was basically facing a crisis and they developed all sorts of new lending tools, liquidity facilities that they used to prop up the markets. Back then, they were even borrowing even buying corporate bonds and even buying muni securities. You had, I think, the New York MTA and the state of Illinois go and basically borrow from the Fed. So what that shows me is that the Fed has enough new tools to basically prevent anything the markets from breaking. So let's say, for example, we do have an episode like the UK, like what we see in the UK, where we have instability in the Treasury market. Well, the Fed would come in and they could do some kind of emergency liquidity facility. Or let's say we have instability in the corporate bond market, something breaks. Well, the Fed can come in and act as lender of last resort. So what I'm getting at is that these new tools that the Fed has pioneered vastly expand its influence and its ability to keep the system together until it brings out inflation. Now, in the past, let's say, for example, in 2018, we saw the equity market melt down, and then the Fed immediately pivoted and started cutting rates. So, because as I've suggested, the Fed is a one mandate bank for now. So you could have the markets crack before inflation is under control. That doesn't mean that the Fed will start easing. That means that it could roll out these facilities and continue to be supportive of markets, supportive liquidity without actually easing policy. If,
Got it.
for example,
Sorry to interrupt, but this is kind of like the Fed saying, look, I'm going to keep doing what I'm doing. I'm going to keep hiking. I'm going to keep tightening, but I'm going to get out my monetary duct tape and I'm going to, hold everything together and I'll figure out how to fix it later on, but I'm just going to keep it from just breaking apart so I can keep going after inflation.
Exactly. Let's say the Fed says, I want to keep interest rates high, but there's a financial accident somewhere. What do? I need to keep interest rates high to slay inflation. And yet there's some financial stability somewhere. What I could do is I could roll out my emergency facilities and start lending to that corner of the market that's broken. I'll lend at rates that are above markets to keep monetary policy restrictive. But I have soft liquidity prices. Boom, we can keep on going. System stays together, and policy remains tight. So perhaps inflation can continue coming down. So I think they got this part as far as something breaking. I think they have enough tools to stop that. What would really cause a Fed pivot, in my view, is the other suggestion that you made, and that is politics. What I read a lot and what I hear a lot is that there are people, political activists, who don't like the Fed's how the Fed made the judgment between its dual mandate. So these people seem to think that the Fed should be focused a lot more on unemployment and a lot less on inflation. So they seem to view that, and Elizabeth Warren is a good example of this, they seem to view that any type of unemployment is unacceptable. Sure, we should protect the people over inflation, which it seems that they perceive as something that rich people care about. And if you have a political force like this who is very loud and perhaps has some influence, then in a few months we're going to be in a place where the Fed has to make a tough choice. Let's say unemployment rate goes up 1%. Let's say inflation goes down 2%. Those voices are going to be very loud, and maybe they will force the Fed to stop hiking. And that actually is exactly the kind of problem that the Fed was facing in the 1970s. Arthur Burns, in his speech, The English is Central Banking, basically openly said that I could stop inflation anytime I want. It's just that I would have crushed the economy, and then people would be unhappy, and that's true as well. So it's whether or
Right.
not the Fed is able to withstand that political pressure to accept that we might have some unemployment to get inflation lower.
Okay. So I want to dig into this because this gets to the heart of a really interesting question. And first off, there is a difference between crashing the economy and some unemployment, right? And I understand that there are politicians whose acceptable unemployment level is zero, right? Like, hey, I don't, any jobs lost are bad, right? But the Fed is supposed to be, and I'm acknowledging that there's an awful lot of skepticism around this. It is supposed to be an independent entity, and it is supposed to live removed from the influence of DC politics. So the larger question for you is like, how true is that? Because there's a lot of people that feel like, yeah, sure, they say it, but of course it's very I don't want to say manipulable, but it's definitely can be pushed around by politicians and special interests.
So I think it's a really great quote from former Fed Chair Martin, who notes that the Fed is, I think, independent within the federal government, but not independent of the federal government. And a lot of the concern back then was, for example, you have a duly elected Congress with a popular mandate running all these inflationary policies. The Fed is not elected. Does it have the authority to push back against that stuff? It would be strange if, for example, Congress was, giving everyone a raise, which is obviously inflationary, and then the Fed would turn around and just kind of hike interest rates and make everyone's day bad. So I think that's the concern that the Fed had at the time, and I think that's the same concern they will have today. I think that the Fed is obviously, heavily influenced by politics. It chairs appointed by Congress, so obviously. So I think it's a very difficult choice that we're facing the Fed in the coming months, and I hope they do the right thing, which is, of course, in my view, to keep interest rates high and higher for longer, as they've tried. But the political pressure would be strong.
All right, I'm going to ask that question a little bit differently, and I know that you weren't sitting, around the FOMC table with the Fed chair when you were there, but if you had to say on net, are the Fed's major decisions made independent of Washington influence, or are they net made because of Washington influence?
So I remember, I think in 2020, when basically Fed Chair Powell was suggesting that Congress could just go big with their fiscal spending and so forth. So that, to me, really hit home the fact that this is part of government. And so I think that the Fed today is very much influenced by Washington, but they're trying to be independent now by doing their strong monetary policy. And again, I don't know how this would turn out.
Okay. And I appreciate you addressing that. I know I'm sort of pushing you to speculate on it, but it's a question a lot of people have. All right. So let's see here. I'm trying to figure out how to get through all of this in the remaining time. I guess when we talk about financial instability, I want to move on from it because you basically said you're not too worried about it because you think they've got their monetary duct tape. I guess the question I'll ask, which you may have already answered, which is current U.S. Secretary Treasury Janet Yellen, who is also a former Fed chair, has been raising some warning flags about the U.S. Treasury market, which is a little concerning because that should be sort of the most functioning market in the world, basically. And I was going to ask you how concerned you are, but it sounds like maybe you're not all that concerned because there are these vehicles that can be used to keep it going.
So I actually was writing about Treasury market instability earlier in the year, and that was always my one main focus of what was it, the next market to break. It was surprised me to see it was actually the gilt market, which is a comparable market, but obviously more fragile. And I'll tell you why that I was concerned about the Treasury market. I'm still am, but again, I would emphasize that there are tools to take care of it. So ultimately, for any asset, anything, it's supply and demand that determines its price. Now, the supply and demand dynamics in the Treasury market are incredibly lopsided. So the demand for treasuries, I'll just give you a brief review. Pre-pandemic, the marginal buyer of treasuries was the hedge fund community. They bought hundreds of billions of treasuries. After 2020, the marginal buyer in treasuries became Of course, the Fed, who bought trillions, and also the commercial banks, who bought a few hundred billion. That was the demand dynamics for the past few years. Now, the supply dynamics for treasuries is completely dependent upon, dependent upon the deficit and dependent upon the Fed. So if you look at um, the Treasury's estimate for issuance this year and going forward, you notice that there's a huge change now compared to a few years ago. The Treasury estimates that issuance is going to be basically $1 trillion a year forever going forward. Whereas pre-pandemic, we were issuing about $500 billion a year. So there's this huge change in issuance. Um, and on top of that, the Fed's quantitative tightening, which at the end of the day increases the supply of treasuries to the market as well. So you have this huge imbalance where the supply is increasing, but the demand, people who are the marginal buyers in the treasury market, the Fed and the commercial banks, have stepped away. So to me, that was a recipe for tremendous instability. What will happen to this huge supply of treasuries and who's going to buy it and at what price? Now, I always expected the treasury market to yields to kind of jump higher one day, kind of like the repo market in 2019. That did not happen. What happened was the gilt market broke and jumped higher. So a similar dynamic. The thing is that markets are reflexive, and so are policymakers. So that what happened in the gilt market basically put the rest of the world on notice, and that's part of the reason why Yellen is saying this as well. Now that the policymakers are on notice, this is possible, they're going to be prepared to take care of it when it does happen. So one day, if that were to happen in the US, then the Fed would come in and they would just stabilize it. So it seems like it'll be a lot less eventful. But from what I see, though, because it broke first in the UK, there are other bond markets that are weaker than the US. You have, for example, the European Union. If you look at who has been purchasing, let's say, Italian, Spanish sovereign debt over the past few years, it's basically all the ECB. And if they're not buying, someone else is going to have to take their place. And they're issuing a lot of debt over there to try to subsidize energy costs. So they're going to have a similar dynamic as well. So if the ECB steps in and tries to stabilize markets there, and you have markets being stabilized in the UK by the Bank of England, that reverberates to the US. That makes it less likely for something in the US to break because bond markets are connected. If you recall, when the Bank of England stepped in and started buying gilts, the gilt yields plummeted, but so did treasury yields.
Right.
Bond markets are connected internationally. So if you have other places breaking first, that means it's much less likely for things to break in the US. So that's part of the reason why I think less concerned about the treasury market than I was a few months ago.
All right. I'm going to say two contradictory things. One is, so it sounds like you're not very worried about a contagion, right? So if we have other sovereign debt markets break, you just said you think that makes it less likely that something's going to break here, but could they break so badly because everything's so interconnected that we do see a contagion effect?
So there's always a timing issue. So if something were to suddenly break, yes, it would immediately affect things here, no doubt about it. We saw that in the UK as well. But the step after that is that no doubt all the policymakers today, they cut their teeth during Lehman. They're going to say, oh my gosh, I don't want the system to implode. So they're going to do whatever it takes. And so some foreign policymaker is going to do something to calm their bond market. Markets will see that their foreign bond markets are being supported. And that stability, I think, will also transmit in the same way that the disorder transmitted.
Okay.
And
could that create, and I know I'm asking you to really speculate here now, but could that create a financial crisis? Meaning, okay, maybe the US Treasury market holds together, but the banking system or, institutions that were big into European bonds or whatever, they experienced some sort of big crisis because they were overexposed.
Yeah. So I think one thing that is really important and that you're touching upon this is that so when asset prices decline, you don't really actually know who are the big investors in it. And when investors have losses, sometimes it reverberates, which we saw in the pension funds in the UK. So if yields continue to go higher, maybe someone somewhere has solvency issues. Their assets decline, their liabilities remain the same, and maybe they have to sell the assets, make margin calls, and maybe there's some financial instability there. I think that's definitely possible, and uh, eventually it will happen if yields continue to decline. Yields continue to rise, prices continue to decline. But again, because when something breaks, it's probably going to happen somewhere else first, it seems, once their policymakers come and support bond prices so that yields no longer rise, that becomes much less probable here in the US.
Right. Well, probable that
Okay.
our treasury market will get in trouble because we would have ring fenced it in advance. I just want to make sure that you're not saying that we can't have another financial crisis elsewhere because of this, which I don't think you are.
No. We can definitely have another financial crisis. Um, so, okay, so I think what something that we should also acknowledge is that treasury yields and interest rates have gone higher and more upwards than any of us ever expected just a couple years ago. Yes, and despite that, nothing has really broken in the U.S. or even globally except the gilt market.
Yeah.
So
I'm going to say
that
just yet. Sorry to interrupt you, but I want your
just
answer
yet,
to incorporate this. Yet, because we talked about there's a lag, right? There's a delay, right?
not for financial markets. There's a delay. If Fed hikes rates, that immediately goes through everyone's portfolio.
I'm sorry. You're right. You're right. You are right.
Yeah. So it affects the economy with the delay, as you mentioned. So so I think what we have to admit is that all those regulations that they did post 2008 did work. It did make the financial system stronger. The banking system is much sounder. So it is more resilient. Um, it's not infinitely resilient, but it is a lot more resilient. And the US in particular is a much more resilient financial system than compared to other countries. And as global yields go higher, my view is that the less resilient systems will be the ones to crack first. That forces their policymakers to act, which actually makes it safer for us because let's say the ECB is doing QE again. Well, of course, that's supportive of US assets since bond markets and risk assets are connected globally.
Right. And this is
So,
the second point I was going to say, which when I talked about two contradictory things, the supportive thing is you're right, which is we see the breakage elsewhere. It gives us, the green light to really get our defenses ready here. So we're less likely to crack. But then all that foreign capital, especially if they start printing more of it, is going to rush here. And it's probably going to go into the treasury market because people are going to be looking for safe haven, right? Which would even stabilize our treasury market even further.
yeah, no, it definitely. So I would say it's supportive of all U.S. assets. Actually, I suspect that maybe it goes into just U.S. large caps, just like the S&P or something like that. Um, again, if people are worried about the sovereign debt market in broad, maybe when they come to the US, they'll look at the Treasury and the US government and think it's not so different. Maybe they would prefer something, I don't know, like an Apple or Microsoft. But I think it's supportive of all US assets. Remember,
Wow.
going back to what we discussed in the very beginning, um, for a foreign investor, it's not just about the price of the US asset, but also the dollar as well. So they could lose by declines in S&P, but make a lot of money from dollar appreciation.
From
So,
the FX, yeah.
and that's of course goes back to Brent Johnson's dollar milkshake and how, and also my view that it would be more supportive. All this, uh, you know, let's say something breaks in the UK and the Europe, that means they can't raise rates anymore. But the US can continue to raise rates. Well, that interest rate differential, stronger dollar, US assets more attractive. That could be more supportive of US assets.
Okay, great. All right, I'm going to go to the question I was planning to ask like 5 minutes in, which shows you how few of my questions we've really gone through because it's been such a great discussion. Um, uh, and I'll take your quicker answer on some of these just so we can maximize the remaining time we have. How high do you think the Fed funds rate will go here? And I know I'm asking you to guess. And in your answer, is there a Fed funds rate at which you just don't think the economy can handle it?
Yeah, of course. So I think the market is pricing at a Fed funds rate, terminal rate about close to 5%. I think that's probably about right. I would say it's very difficult to go to like say above even higher, but I was surprised that we can get here in the first place. So I've been wrong about on this. So the reason that I don't think that will be something like Volcker in the 70s where Fed funds can go to 10, 20% has to do with the structure of the financial system. We don't have to go all that much higher to have a strong effect because there's a lot more debt in the financial system. The way, in my view, how monetary policy is transmitted is through the debt market. So when the Fed is raising interest rates, what it's also doing is that it's haircutting the value of your debt. It's taking money out of your portfolio because we have so much, the level of debt is huge. The small changes in interest rate destroy large amounts of value. So we
Right.
don't actually have to go super high. Think about where we are. Seems to be working so far.
Okay. And this is a topic I wanted to get into you earlier, and I think we're going to have to mention it and then dig into it on your next appearance on the show. Same with the mechanics of quantitative tightening I wanted to get into with you, but I think to do that justice, I got to give you more than just a couple of minutes. But that was one of the deflationary trends I was going to mention, right? Which
Okay.
is our debt and our exponentially increasing pile of debt, and the fact that we are increasing the cost of its capital here, given current policy, right?
Yeah,
I guess feel free to comment on that in any way if you will. But
sure,
let me
sure.
tell you
Yeah,
why that's
okay.
germane. I've heard a number of people say that that's what's going to force the Fed to pivot, is that the debt service on the federal debt is jumping so much that it's going to get to a point where we just can't withstand interest rates this high, and they're going to have to be brought back down to make those debt service payments more manageable.
That doesn't sound like Congress to me. I mean, they can throw $1 trillion in Afghanistan, but suddenly, oh my gosh, I can't afford my interest payments. I don't think there's anything they think they can't afford. So the answer to that is interest expenses would just be printed, of course. So there's no constraint, none at all on interest
Okay,
levels
but
for
Congress
the US
doesn't have
sovereign.
that. Congress can't do that, right? It's got to have the Fed's
Oh, well,
participation
okay,
to do
yeah.
that, right?
So how would they pay interest payments? They would just issue more debt, right? They would just issue, if I need to pay interest rate payments and my tax receipts are not high enough, I'll just borrow the difference, which is the exact same thing they've been doing for decades. So that I can't imagine why that's a constraint. They're just do the same thing they've been doing. I think though that when you want to talk about the link between debt and inflation, it's very important to make a distinction between private debt and public debt. Public debt, as I suggested before, is basically a form of money. Government, let's say, buying a tank with deficit spending, it's basically buying a tank by issuing treasury securities. And what happens how does it repay those treasury securities? Well, it just, rolls it over and issues a new one. So far, doesn't seem to be a limit to that. So it's very difficult for me to see how that could ever be anything but very inflationary, since you're basically creating money. Now, on the private debt side, that can be deflationary because if you have a large amount of debt and you have to make interest rate payments, that means you have less discretionary income to spend. I'll calculate that with 2 points. One, if you are a debtor and your interest rate payments are high, so that money that you pay, it goes to someone else. It goes to whoever lent you the money. So it actually doesn't disappear. It just goes somewhere else. It's a redistribution. So, maybe the person who lent you money will go out and spend all that extra interest income it has. So that's not super clear to me. The second point is that interest rates today, a huge swath of the US economy is locked into very low interest rates. So if you have a mortgage, you're like 2.5%, 3%. Sure, you have a lot of debt. You have a lot of debt that's super cheap. And that is becoming, less onerous as inflation rises. So it doesn't seem like that's super restrictive. In the corporate world, it's actually very similar. They've pushed out their maturity walls and locked in a whole bunch of cheap funding, um, such that they really won't have to refinance for a few years.
Okay. God, it keeps raising so many questions I want to get into with you. Just super quick on this one on housing. from your comment, I would intuit that you're not that worried about what's happening in the housing market right now. My bead has been that, just the mathematical relationship between mortgage rates and home prices. There's a whole bunch of other factors, but that one at the center of it is going to be dragging down home prices going forward. And yes, there's a lot of people who can quote unquote stay in their home because they have, they've locked in a low mortgage rate. But houses are priced at the margin, and it's the houses that are going to sell that are going to set the market value. And so while you might be hunkering down in your house, you might be seeing market values in your neighborhood plummet by double digits, maybe a lot of double digits at some point. And that will create a negative wealth effect, especially if it's combined with continued losses in the financial markets that could really, make that recession we were talking about a lot more probable.
Yeah, I agree. And actually, I think that's exactly what the Fed wants to do. They want to make housing prices lower. They want to make equity prices lower. Remember, back to the channel, wealth effect channel, less money, less wealth, less money to spend, less inflation. House prices are still comfortably above pre-pandemic levels, equity markets as well. It looks like, as you suggest, that house prices will continue to decline. Mortgage rates are at 7%, so obviously that has an impact as well. But I think the U.S. is a bit different in the sense that we have 30-year fixed mortgages. So even though on the margins, the guy who's trying to buy a new home is going to be in a lot of trouble with high mortgage rates, but everyone else, and there's a lot of people who are locked into very low mortgage rates, so they're basically insulated from higher mortgage rates. They continue to they have 2.5%, 3% mortgage rates. Their wages are going higher, 6% a year. That's that's improving their financial situation
if they keep their job. Yeah. My point is more,
yes.
it's a psychological thing, right? I mean, if you're locked at your
absolutely.
house. Yeah.
Absolutely. So I agree that that's a channel that could have deflationary impacts. And that's what the Fed is trying to achieve.
Okay. So we're coming up in the hour here. So I'm going to have to start trying to reel this in. And I couldn't finish this conversation without touching on this topic, which is a lot of people, and I'll be honest, myself included, lay a lot of blame at the Fed, not all of it, but a lot of it, for the situation in which we find ourselves in. This is, asset bubbles,
Yes.
right? Historically high valuations or overvaluations in financial assets, in assets like housing and whatnot, right? An economy that's addicted to basically zero cost capital or incredibly cheap capital, right? That buckles under what used to be, low, to forget even about moderate interest rates, and that those financial bubble, those asset price bubbles have led to a really extreme wealth inequality in the country,
Yes.
right? So I guess two questions for you, but they're related. One is how culpable do you see the Fed for creating those conditions? And then secondly, is what the Fed is trying to do here is I think for a long time, the Fed has wanted to get some of this stuff under control. I don't think these guys are idiots. I think they feel like we kind of created this monster, and we'd love to get them under control. But historically, whenever they tried to, the system got real shaky and they had to step in to rescue it. Is Powell basically saying, like, I'm going to use this, don't let a crisis go to waste, kind of like, I'm going to use this inflation crisis as my excuse to try to just beat this stuff down as low as I can. And yeah, if I got to sacrifice jobs, I will. If I got to sacrifice asset prices in the markets and, throw us into a recession, I will, because basically that's what the Fed officials have said over the past couple of months. Like,
Yeah. So I think you're exactly right on both accounts. So, and I'll also say that the Fed actually is kind of open about this. So let's rewind back to post GFC, 2009, 2010. We have a slow economy, interest rates are low. The Fed doesn't want to stimulate the economy. It doesn't know what to do. So, of course, they can't just give everyone checks like Congress could. So, what Bernanke seemed to try to do is to try to do to create a wealth effect. So what that means is that so the Fed can't give you money literally, but what if the Fed makes your 401k go higher? What if the S&P goes higher? Perhaps you have a little bit more money that you can go and you can spend. That stimulates the economy. Growth comes back, inflation comes back, and so that was the plan. And I have to say that it worked. So, well, not the growth in inflation so much as the asset part, which is what the Fed could control. That you
Right.
saw the S&P.
Didn't juice the economy as much as they'd hoped, but it sure
So
juiced the rich people's financial
yeah,
portfolios.
so that was I think kind of the stated intention, portfolio and rebalancing wealth effect. So that's what happened. So the important thing to take away from this is that the wealth effect is a policy tool of the Fed. And so when we fast forward to where we are today, where inflation is very high, that wealth effect is also a tool, but it works in a reversed way. So you have a reverse wealth effect where you get wealth down to make people feel poor so that they consume less so that inflation comes lower. I think that's basically been telegraphed through the early part of the year. And as you suggest, they've been very open about it. Um, so yeah, I agree with your assessment.
Okay. Small comment, small question, large question. Small question is I was interviewing Pedro de Costa recently, and I'm sure you know him, but he's covered the Fed for decades and talks to all the policymakers. And he said that he is kind of getting the impression that QE as a stimulative tool is going to be retired. Is that the folks that he's talked to have said, yeah, it's kind of been more trouble than it's worth. It didn't goose the economy as much as we had hoped, and it created this big wealth imbalance that we're getting a lot of blowback for, and it's we don't want to create that necessarily. I saw you sort of furrowed your brow, so I'm just curious. Do you have that same sense or not?
I think that QE. So I think the context today is very different from the context, let's say 10 years ago.
And I'm sorry, before you answer, let me give you one qualification he gave me. He said it'll still be in the toolbox as like an emergency lending facility, or purchasing assets of a super distressed entity that's about to die and we're trying to keep it alive. But in terms of this, just sort of like, we're going to try to stimulate the economy by month after month of just buying assets, that he thinks that's the part of QE that's being retired. So I'm sorry, go ahead.
So I think Pedro is very well connected, and his MNI News is phenomenal. It has a whole bunch of really good speakers from the Fed, former and current. I think that the problem is that the Treasury market has grown so large. As I mentioned before, the US government seems to think that it can issue $1 trillion in Treasury securities every year forever. I think it believes that because in the past, the Fed has been supportive of the Treasury market. If the Fed were to retire QE, it might find that interest rates go much higher than they expect, and that could be very destabilizing. So I look at it in the context of financial stability, that maybe it doesn't have to be QE, but maybe something like yield curve control, where the Fed basically stands ready to purchase unlimited treasuries at a certain yield, like Japan, could be the future of what would happen to the QE. So instead of just buying again over and over again, as they have, buying every month as they have in the past, but maybe just more like the Bank of Japan, where they just have that, I guess, that
QE
ceiling
eternal.
there, and the ceiling there just as an emergency backstop. So usually what happens though, if the Fed is willing to say that I'm going to buy any treasury yield that's any 10-year, let's say yielding above 6%, that it would never trade about that because no one challenges the Fed. So that could mean less QE because people will not challenge the Fed. But it also means that the Fed is able to have better control of the treasury market, less financial stability concerns.
Okay. All right. Very interesting. Okay. So last question before I let folks know how they can go find you and learn more about you and your work. Joseph, I anoint you. I make you Emperor of America. What reforms, if any, would be at the top of your list when it comes to central banking?
So I think, in my experience at the Fed, I think one of the huge problems was that there was very little accountability for people who made terrible decisions. And this is true, to be fair, of any government organizations. In any government organizations, basically, it's like a business that can't fail, run by people who can't get fired. Now, if you have a normal organization, people join and some of them leave for better opportunities and some of them perform very poorly and they are terminated. But for the Fed, like many other public organizations, the good people leave, but the bad people stay forever. And eventually you get an organization who's basically not able to function. It's like a zombie organization. Everyone's just sitting there collecting checks and no one really knows anything and doesn't really care. And that's fine for a lot of government organizations, but for the Fed is a very powerful institution, not just for the US, but for global monetary policy. So that kind of management doesn't work. So I would like to see a lot more accountability for people who made bad decisions, maybe more involuntary turnover.
Okay. So on that type of dysfunction, on a scale of 1 to 10, with 10 being just, the worst, how would you rate the Fed right now?
The Fed has made some serious errors in judgment over the past couple years. For example, inflation being transitory. For example, buying mortgage-backed securities, even when housing prices are up 20% year over year. So I think it's fairly high in its dysfunction. And I like Chair Powell. I think he's a smart guy. I think he's doing his best. But the thing is, he's just surrounded with all these people who we didn't hire and he can't fire, who are feeding him very bad advice all the time. So I think there has to be serious reform on the staff level of the Federal Reserve banks.
Okay, and how does it work there? Is it more like a monarchy, where the chair, currently Jerome Powell, really is the decision maker and everybody else gives input, but he's the guy making the decision? Or is it more where he's got to build coalitions and influence, get the votes he needs?
My sense now, again, my sense is that, of course, his vote counts the most, and after him, it's the vice chair and president of the New York Fed. But they always try to have consensus. So it's important to build coalitions to have the appearance that we're on the board, because from their perspective, monetary policy, a lot of it is about conveying expectations and things like that. But I think that he could definitely, his vote counts for a lot more than, even if he doesn't have everyone on board, I'm sure he could do what he wants.
Okay. That really was sort of where I was going. All right. Gosh, I already know the questions folks are going to be shouting at me that I didn't ask you. Maybe I'll just ask you to react to these two and just give me quick answers. We can go into them in depth the next time you're on. One is, should interest rates be set by the market and not by the Fed? And then secondly, I guess two others. One, does the dual mandate make sense? And then the third one is do you think we should even have a central bank at all? I'm guessing you think we should, but I'll let you answer those in any way you like.
Yeah, so I think they're related. So the first is that, yes, we definitely need to have a central bank. And here's the thing, though. So I think of things from an evolutionary perspective. We have these problems, we find solutions to those problems, and as a society, we progress. We've played this simulation many times, and at the end of the day, even when the simulation is played abroad, we come up with the conclusion that it's actually good to have a central bank as the lender of last resort. Prevents less banking panics, and which are much worse than anything that you could experience when you have a Fed. Now, if we can acknowledge that we do need a central bank, or that at least a central bank is good, then we have to go to the next question. How are interest rates set? Because if you have a central bank willing to provide lender of last resort, obviously the central bank has to choose a price that it's willing to lend money at. And so therein lies the influence between where the central bank sets rates and where the market sets rates. And so what the central bank does, it basically sets a maximum rate. Market rates are usually lower. So they work together in setting. So for example, if the Fed were to set the discount rate at 5%, well, the market could trade at any level. It just wouldn't trade above 5%, because then you could just go to the Fed. So the two actors, the market and the Fed, they work together. Now, whether or not they should have a dual mandate, I actually don't think so. In fact, I'm not even sure they can meet their current mandate anymore. The reason is, as I've suggested in the past, is that inflation is not just about the Fed, it's also about Congress as well. If Congress spends a lot of money, then, and they keep spending a lot of money, then even if Fed raises interest rates a lot, they're not going to be able to quell inflation because a lot of inflation comes from the government. So
Right.
um, if we have, so we're kind of putting the Fed in a very tough spot by giving them a responsibility and yet not the capacity to carry out. Uh, just looking at interest rates, for example, raising interest rates does not decrease government spending because Congress doesn't really care about interest rates. It's a political choice. So 100 years ago, when we had a very limited government, I think we could have the Fed and we could give them responsibility to change interest rates to stop inflation because private actors react to the cost of capital. Government does not. Back then, much of the economy was the private sector. Today it's a lot more difficult for the Fed. So, I'm not quite sure if um, you know if they're able to do what they have to do now. It's not their fault. It's just the structure of the economy and the government has changed.
Okay. Well, look, I really appreciate you answering those last few ones I just tossed at you there. When we have you back on, if we want to go more deeply into any of those, I'll give you plenty of time to do that. We've gone way over time here. I thank you for spending so much of it with me, Joseph. And this has been a fascinating discussion. I feel like I've learned a lot more about how the Fed operates in this conversation than I have in one in a long time. And I'm sure a lot of our viewers feel the same way. So thank you so much for that. For folks that would love to continue learning from you and would like to follow you in your work, where should they go?
So first of all, I'd like to thank you for inviting me on Wealthion. It's been a pleasure and happy to come back and discuss about the Fed. I'd also highlight that if you're interested in monetary policy or the structure of the financial system, I have a book called Central Banking 101. It has hundreds of 5-star reviews on Amazon.com. It's a very good resource if you're interested in the topics that I discussed. And if you're interested more about day-to-day market commentary, I can be found at fedguy.com, or you can follow me on Twitter, fedguy12.
Okay, fantastic. So it sounds like the best place to get your book is just go to Amazon or your
Amazon.com.
local bookseller. And when we edit this, Joseph, we'll put up the links there to your Fed Guy Twitter and website, so folks very clearly know where to go. All right, folks. Well, look, as you hear me say on this program a lot, in case you're new and maybe you haven't, for a lot of the implications of what Joseph was talking about here, you probably got a sense following the logic of this conversation, the detailed logic. It's a very complex, complicated time for today's investors, especially trying to navigate a situation that could be kind of turned on a dime in many ways by a policy shift. And so we highly recommend that you work with a financial advisor during this period who understands and takes into consideration the issues that we talked about here. If you have a good one, great, stick with them. But if you don't, or if you'd like a second opinion by one who does, feel free to talk to one of the advisors that Wealthion endorses. Doesn't cost you anything. There's no commitment to work with them. It's just a public service that gets offered. If you're interested in that, just go to wealthion.com, fill out the short form there, and we'll set up one of those conversations for you. I also want to remind folks that we are continuing our process of me writing up my key top takeaways from these interviews. This one has a lot of them, so I'm going to be writing an awful lot about this. If you would like to get access to those notes for free, just go to wealthion.com/AdamsNotes. And if you'd like to see Joseph back on this program and other great guests of his caliber, please do us a favor and support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Joseph, can't thank you enough for all your time here. Really appreciate it. Everybody else, thanks so much for watching.